Credit Suisse, how scandals crippled a 167-year banking titan. At the heart of the global financial system, some banks are seen as pillars of stability, institutions that have weathered wars, crises, and booms for generations. Credit Suisse was one such institution. Founded in 1856 in Zurich, Switzerland, it built a reputation over more than 160 years as a trusted private bank, wealth manager, and corporate lender. It was a name that evoked precision, discretion, and strength in the high-stakes arena of global finance. But by 2023, Credit Suisse had become a cautionary tale, a once mighty titan brought to its knees not by a single mistake, but by a series of scandals and strategic missteps that shattered trust, drained capital, and ultimately ended in a forced takeover by its Swiss rival, UBS. How did a bank with roots stretching back to the mid-19th century spiral so dramatically? To understand, we need to trace a series of landmark events, miscalculations, and crises that exposed deep flaws in risk management, leadership, and corporate culture. These failures mattered far beyond Switzerland's borders. Credit Suisse's collapse sent shockwaves through global markets, rattling investors and regulators worldwide. Credit Suisse started in 1856, spearheaded by Alfred Escher, a visionary Swiss politician, to finance the country's expanding railway network. It quickly grew into Switzerland's premier bank, pioneering private banking and wealth management, becoming synonymous with servicing the ultra-rich across Europe and beyond. Its Zurich headquarters became a symbol of Swiss banking's famed stability and discretion. Through 2 world wars and the financial upheavals of the 20th century, Credit Suisse was considered a bedrock institution. Fast forward to the 21st century, and the financial landscape had shifted dramatically. Credit Suisse transformed into a global powerhouse, operating investment banking desks in New York, London, and Hong Kong, alongside its traditional private banking activities. This diversification brought new revenue streams, but also new risks. The first cracks began to emerge in the wake of the 2008 global financial crisis. While Credit Suisse avoided the worst of the subprime mortgage fallout compared to some U.S. banks, it never fully repaired its risk controls. Instead, it doubled down on risky bets in emerging markets, leveraged lending, and complex derivative trades designed to boost short-term profits. Over the next decade, a series of scandals and blow-ups exposed just how vulnerable the bank had become. One of the earliest and most damaging was the spying scandal of 2019. Internal investigators uncovered that Credit Suisse executives had hired private detectives to spy on former employees and board members. The target was Iqbal Khan, a high-profile asset manager who had left Credit Suisse for key positions at rival UBS and then started his own firm. The revelation that a major bank would secretly track its own former executives was a serious breach of ethics and privacy laws in Switzerland and beyond. It led to resignations at the highest levels, including CEO Tidjane Thiam, who stepped down abruptly in February 2020. The scandal not only eroded internal morale, but also tarnished the bank's reputation for integrity, which is a cornerstone for private banking. But the spying scandal was just the canary in the coal mine. Shortly after, in 2021, Credit Suisse suffered a much larger financial blow with the collapse of Archegos Capital Management, an investment firm that effectively defaulted on massive margin calls after highly leveraged bets on several tech and media stocks went bad. Archegos had placed trades through Credit Suisse worth more than $30 billion. When its positions unwound rapidly, Credit Suisse was hit with losses totaling about $5.5 billion, the largest quarterly loss for the bank in over a decade. Analysts quickly pointed to failures in risk management and controls. Credit limits were exceeded, exposure was opaque, and the bank was slow to cut losses. In the same year, the bank also took a hit from the downfall of Greensill Capital, a UK-based supply chain finance firm that had packaged and sold billions of dollars of risky loans, with Credit Suisse acting as the primary investor. When Greensill collapsed amid allegations of fraud and regulatory scrutiny, Credit Suisse had to freeze $10 billion of funds connected to it, triggering a crisis of confidence among clients and investors. The bank was forced to write down $4.7 billion as a result. These twin shocks, the Archegos and Greensill implosions caused Credit Suisse's stock price to fall by over 40% in 2021 alone. The bank's credibility was in tatters. Investors and regulators questioned how a firm of its stature could mismanage such massive exposures. What followed exposes a pattern of poor governance and strategic drift. Credit Suisse's board shuffled through multiple CEOs in a short period, with Ulrich Korner taking the helm in mid-2022 to try to steer the bank back to stability. Korner initiated restructuring plans to cut costs, shrink riskier operations, and improve capital buffers. However, confidence was eroding fast. In early 2022, Credit Suisse faced another reputational blow with the reported involvement of the bank in what became known as the Swiss Secrets Leak. This was a data leak of thousands of documents that revealed the bank's private banking clients included dubious figures accused of corruption, money laundering, and even links to organized crime. While Swiss banks have long championed client secrecy, the leak spotlighted the ethical concerns tied to laundering money through the global banking system. A systemic challenge, but one Credit Suisse in particular was implicated in due to lax know-your-customer checks. The accumulating scandals and financial hits coincided with difficult market conditions. Rising interest rates put pressure on Credit Suisse's clients. Asset values fluctuated sharply, and volatility in global markets unsettled its trading operations. For a bank heavily reliant on fee income from client transactions and wealth management, these were perilous wins. But the final nail in the coffin emerged in early 2023. Credit Suisse's troubles magnified dramatically when a historic loss announcement triggered a crisis of confidence among depositors and creditors. The bank reported that it would need to raise fresh capital, causing fears about its solvency to spike. Shares plunged sharply. Moody's and other credit rating agencies downgraded the bank's creditworthiness to near junk status. The Swiss National Bank stepped in to provide emergency liquidity, but made clear that a swift solution was needed. The global financial system is tightly interconnected. Credit Suisse's fall threatened to create ripples beyond Swiss borders, exposing lenders, investors, and counterparties across the world. Regulators feared a chaotic collapse like Lehman Brothers in 2008, which had nearly triggered a systemic meltdown. Instead, Swiss authorities brokered a rapid sale of Credit Suisse to UBS for approximately $3.25 billion in March 2023. UBS assumed all liabilities and agreed to certain stabilization measures backed by the Swiss government. This takeover marked the end of Credit Suisse as an independent entity, ending a 167-year run. The combined entity became Europe's largest bank by assets, with over $1.6 trillion under management. While the deal avoided a disorderly collapse, it also underscored the vulnerabilities in modern banking ecosystems, where scandals, risk mismanagement, and eroded trust can rapidly bring down institutions once thought invincible. The downfall of Credit Suisse illustrates how repeated governance failures and risky strategic choices can accumulate, turning reputational damage into real financial stress. The bank had ignored numerous warning signs over the years, prioritized short-term gains over sustainable risk control, and failed to uphold the stringent ethical standards demanded by its clients. As the scandals piled up, the damage to client relationships and investor confidence became impossible to reverse. The story connects to broader themes reshaping global finance. Swiss private banks once enjoyed almost unrivaled secrecy and trust, but increased regulation and transparency requirements are changing the industry's landscape. The rise of digital finance, geopolitical tensions, and more aggressive competition from U.S. and Asian firms challenge legacy banks like Credit Suisse to innovate while managing risks prudently. Moreover, the Archegos and Greensill episodes spotlight the ripple effects of shadow banking and opaque financial products. Banks acting as intermediaries for complex risks without full oversight can inadvertently amplify systemic vulnerabilities. Credit Suisse was a case study showing how opacity and risk concentration can threaten not just an individual firm, but the broader financial ecosystem. On an individual level, Credit Suisse's collapse had concrete impacts. Wealthy clients scrambled to move assets, employees faced uncertainty and layoffs, and investors took significant losses. Swiss taxpayers and regulators now grapple with lessons learned about oversight and crisis management. In conclusion, the tale of Credit Suisse is a stark reminder that no institution is too big or too old to fail. It highlights how a combination of opaque risk exposures, governance lapses, and reputational damage can erode a bank's foundation over time. In a world where financial scandals can unfold with alarming speed, Credit Suisse's demise serves as a potent example of the need for transparency, prudent risk management, and ethical rigor in banking. The mechanics here, how successive crises compounded to undermine the bank, offer a blueprint for regulators and financial institutions aiming to prevent the next collapse. The global economy cannot afford another Credit Suisse. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Martha Stewart. How a $45,000 stock sale led to a federal prison sentence. You will not want to miss it. I will see you there.